Okay, so welcome, guys. Great to see you all. Nice to have everybody here with us. And great to have you all. We'll go right here. I'm just gonna minimize that, keep that kind of in the corner there for us. So happy Thursday evening to everybody. Very happy to be with you guys. It's always a pleasure. So I want to hear from you guys today. I want to hear what everybody's up to. Oh, hold on. Okay. Very good. So great to see everybody. It's a lovely Thursday here. I was outside for 2 seconds throwing the ball for the dog, and there's some sun. I'm picking up a little bit of sun, so it seems like we're slowly creeping out of spring. Where I am in Utah, pretty high elevation, Park City area. And I heard somebody say it perfectly the other day. They said Utah just has there's winter, and then there's summer, winter, and then there's summer. And that's the truth, because we've had all these like 70-degree days, and then it snows, and then it's 70, and then it snows, whatever, I don't know. But we've had a lot of that. So nice to get outside and get some sunshine. Soak it all up. It's definitely nice. Okay, I hope everyone's well. I want to hear from you guys. I want to talk about one simple concept today only. You guys, of course, can bring up whatever you want. I will happily answer any questions. But as far as on my part, what I want to discuss today is one thing. And of course, one thing, of course, turns into 12 or 14 or whatever. But I want to just talk about one very specific concept that has been on my mind lately, as we've seen some of our favorite stocks, right? We've seen some of our favorite stocks do this, right? CLF is like a favorite. I love CLF, and we've seen it do. It's terrible drawing. But we've seen it just, go up and down and just kind of, it's just not doing much, right? CLF's kind of boring us to tears, and it's one of my favorite stocks. Alcoa is probably a favorite, and it's been doing a little bit more, but CLF's kind of just been stuck here, right? A lot of them have been stuck here. Our US Steel, pretty stuck here. Everything's kind of just stuck in this little zone. And so what I want to do is just kind of discuss what this means and how this is going to function for all of us here in the group. What this means, how it's going to work, everything. So in this case right here, we've seen just a lot of slow, boring markets, right? Now, by trade, pun completely intended, I'm a big Forex trader, right? And I trade Forex, and I've been doing it for a long time. And one of the reasons I decided to, start doing a lot more with options in the group than Forex is because Forex gets sideways, stocks get sideways, everything gets sideways, right? In the currency market, when things are stuck sideways, there's nothing we can do. We just have to wait. There's nothing you can do. When you're trading Forex, normal Forex, right? If you're trading futures, Forex futures, there are things you can do. But when we're trading just typical Forex, like we normally do, if the market goes sideways, if we end up seeing, something like this, right? And there's just kind of long-term, there's some little runs, but it's just a lot of sideways activity. This really hasn't made any significant movement since July of last year, right? Which is insane. Now, this may look like a huge movement from 116 to 123, and there's a couple hundred pips there, and that's an okay move. But if you were in a sideways position, if you got in here thinking this was going to create a bull flag and it kind of pulled back and made a little bit of run up, there were some profits to be had. So there's really one kind of decent trade in the last 8 months or so, right? And that happens in the currency market a lot. And that's why I said, okay, we need to do a lot more with options and stocks and so on. Because this is not a new concept, and we've been talking about this a bit for the last couple of weeks, because when we see our stocks go sideways, we can do mucho do you guys, this is what I want to talk about. This is the one thing, not 11, one. What I want to talk about is this specific concept of if CLF stays at $17 for the next year. For the next year, what are we going to do? What do you guys think? If CLF stays at until, I don't even know what the date is, until April of next year, CLF stays at 17 bucks, goes up to 18, goes down to 16.50, just stays at 17 bucks. Yes, this is exactly right, guys. Yep. We will, I mean, I'll strangle myself, but I will strangle CLF as well. Yes, exactly. Aris and Dom and Janae and Lenny and everyone. And Mel, yep. So here's what now our CLF strangle, now this one was a little bit longer. Let's look at these numbers here for just a second. This CLF strangle I put on, and it had about a 10-day expiration, right? And this is why we've got the old calculator. Are you guys seeing the calculator? You see the calculator there? Okay, good. So on this one right here, we got 50 cents from the lower and 72 from the upper. Now that is divided by 2, so it's about 61 cents, right? 61 cents. Now that was oh, whoops, good grief. Anyway, 61. Now that was about 10 days, right? About 10 days. Let's see, today's Thursday. CLF actually is up a little bit after hours. You can see it's up about 60 cents from where it closed. So it's up a little bit after hours, but let's say that we put another strangle on CLF, right? We put another strangle on. Again, we're going on the assumption that CLF stays sideways. And we got to give it some room and so on. But let's say we put on an 8-day expiration. Let's say we do, I don't know, 19 bucks and $16. Doesn't seem to be getting too much below that. Maybe we go, you know what, CLF's struggling, you know, might not even get above 18.50. And so here we go. So I'm going to sell an 18.50 and a 16 for the next week, which I think is probably a pretty reasonable thing to do, right? Is ours expiring? Did we say ours expires tomorrow? Yeah, so it expires tomorrow. Now, if we did the same expiration, let's say we go out 2 weeks, you know, getting pretty unlikely, but we pick up, you know, about twice as much. So it's pretty good. But let's just say we go for 8 days and we say 16 and 18.50, we pick up 43, 44 cents. Here's what I am curious about. Now we own, once this strangle expires, this is going to put my break even right at about 15 bucks. Let's say that we can get, about, let's just say 40 cents. We'll say an even 40 cents, not even the 44 cents. Let's say we get an even 40 cents and I own CLF at $15, right? And let's say I can get 40 cents every week from selling a strangle, right? So $15 break even divided by 40 cents I can get every week is 37.5. So that means it's going to take me approximately 37.5 weeks, about 2/3 of a year, to own CLF for absolutely free. I'll own it. CLF will have cost me nothing, right? It will have cost me absolutely nothing. If I can sell strangles and I don't get the stock called away, again, we're going on this assumption that CLF is going to go nowhere for the next year. In 37 weeks, I will have a break even of $0 on CLF. Have you guys thought about that before? Has this occurred to anybody? Because obviously we know this fundamentally. We say, okay, I'm lowering my break-even price. But if we put these numbers kind of to work, and we say, you know, like I know some people that are in CLF from $6 and $7, right? And they're holding on to it and they're like, yeah, I'm doing so great. We could own CLF at $6 or $7 in probably 6 months, right? If it does nothing, in 6 months, we can own CLF at $6 or $7. Another couple of months, we can own CLF for absolutely free. And that goes with every other stock that belongs to this, right? And the thing we have to think about, right? I mean, this is a strangle. A strangle pays a little bit more. Maybe we just are selling puts, right? Maybe we're just selling calls. Maybe we're doing whatever. But to give you that idea of here's a stock that cost $15, that we own it at $15, and we're selling options that are paying us 30 to 40 cents a week, right? 30 to 40 cents a week. It doesn't take that terribly long to incredibly bring down our break-even price to the point that we own the stock for free. I don't know if everybody's getting that. Own the stock for free. That's the ultimate goal of any trader ever, right? Is to buy. How many people are thinking to themselves, holy crud, I wish I would have bought Microsoft at $30, right? I wish I would have bought Microsoft at $30. Here it is at $250. We could own Microsoft at $30. It's going to take us some time, right? It's going to take using some of these strategies, but we could own Microsoft at $30. We could own Microsoft at $0, right? We can own CLF at $0. We can own Key at $0. Some of these will take longer than others. We'll have some setbacks along the way. But when you guys think of these, Chipotle, for example, when you think of some of these stocks that have made a crazy run and we're going, crap, if I could just rewind time, right? If I would have bought Tesla at $30, at $80, at $150, whatever, you can own all these stocks at this price. This is the absolute number one defining factor between trading options and trading absolutely everything else. When we're trading currencies, for example, yes, it would have been great to own, to have bought the Australian dollar versus the US dollar right here at 55 cents. And here it is trading at 77 cents, right? That's 2,200 pip movement. Would have been great to own it there. If this were options, we could own it here, right? It would take us some time. And if the Australian dollar kept going higher, it doesn't matter. That just benefits us more, right? And the same thing with these stocks. We can own CLF right here, right? We can own it right here. It's going to take us some time. But if we incorporate these, oh, whoops, that's the wrong, anyway, but it's the same concept. If we incorporate these cost-reducing trades, we can own these stocks at these lowest prices. Takes a little bit of time. It takes several months for that to happen. But when we have these moments where, because I've been thinking about this a little bit, and I've been thinking, good grief, the trades that we're in are moving so slowly. They're just, they've had a real slow couple of weeks, and they're moving so slowly. But all of the trades, all the stocks that we own that have been moving slowly, we are heavily focusing on the types of cost-reducing trades that we can do, right? Short strangles, covered calls, just selling another credit spread, right? These are all things that can bring down the cost of owning these stocks week after week after week, to the point that eventually, if we are active about doing this and we're careful with our strategies, right? We're looking at CLF, we're going, this thing's pretty slow and steady. I'm going to just keep selling some options on this, maybe some short strangles. I'm happy to own more shares below my short put. And if I have to close my short call in maybe a small loss or at break even because the stock's starting to make a run up and I don't want to lose the stock, I'm still going to have some short put credit there, right? So if I have to close that short call, maybe I don't make my 40 cents, maybe I make 20 cents, but I'm still doing something, right? And these seem like really small numbers, but when you think about it week after week and month after month, and especially if the stock price is going up and we're using options to bring the cost basis, the level at which we own these stocks down, we're making this divide, right? And in that middle point is where all of our money is. If we own the stock in April right here, which is pretty accurate, and the stock's trading today right here, which is pretty accurate, well, what happens is if this stock continues to rise and we're continuing to sell options on this, and we're bringing down that break even, the further apart these numbers go, the more money we're making, right? Eventually the stock's trading up at 20 bucks and our break even's down at 10 or $11, right? And now this trade that actually hasn't moved that much, maybe it moved from 17 to 21 or 22 bucks. But along the way, we've been selling options and lowering that break-even price. We're in a major way expanding our profit potential. So obviously in the group, since day one, we've been selling options and doing everything we can to lower the break-even. But I wanted to really drive home the fact that this is literally a pause in time. This is literally rewinding time for us and saying, here's this stock that is trading at 20 bucks. I wish I would have bought it at $2. You can own it at $2. It just takes a little bit of time. And so, but the issue now is that IV rank is very low and premium we collect is lower. Yep, there's that situation. But of the stock that we own, our implied volatility is great. We're making great money on these stocks. Now, there are some, right? Like Key, for example. And Key's probably the only one that has, some lower implied volatility, and it's paying us less on the options, right? But it still pays us something. We can still put a credit spread on there, and we can still get 50 cents out of that thing, or 40 cents, and it might take us 2 weeks instead of 1 week. So maybe it ends up taking us twice as long to own that stock at zero, but we're still making money on it. So that's not a problem at all. That is a great thing, right? Because when implied volatility gets crazy low on a stock and the options aren't paying much, the biggest example is probably AT&T, right? AT&T and Ford and GE, these guys don't pay anything. So we can always do a 2-week credit spread, sell an at the money put, buy a put $1 below that, and we can still get that 40 to 50 cent range that we want. So we have lots of ways of doing this. This is great. Janae, I like that we keep making money without putting any more money into the account. Yeah, that's great. It's so great. Because even though the money seems small, right? Remember that the money that we're making is small money for a stock that's not moving, but that money is ultimately lowering that beautiful break even while the stock price, hopefully as time goes by, continues to go up. And that nice little space in between those two numbers is where we get real excited, because that's where that's where we want to expand those numbers as far apart as possible, and continue to just enhance that profit. So again, guys, we all have the opportunity here to own all the best stocks at the lowest prices imaginable. When people talk about things like buy and hold, I'm going to buy and hold, and buy and hold works great for some. But how much more can we make when we're doing a buy and hold? How much more can we make if all along the way we're doing some real low risk option selling? We're selling options that that either don't risk the stock getting called away, or when the stock goes through these long periods of sideways movement, we can do more aggressive strategies like short strangles and so on, so that we can, more quickly and more profitably lower that break-even price. So good. And so it's such a significant point, and it's a point that I definitely wanted to make today about, we're sitting in these stocks and they're going nowhere. This short strangle, for example, that we put on CLF, it's like, and honestly, I don't think CLF has hardly moved. I think it's probably gone down a little bit since we got into that short strangle. But it's like, it's like over the last week or week and a half, it's like CLF moved up 60 cents. Better than nothing, right? And CLF didn't go anywhere. Actually, CLF went down a little bit. But for us, CLF moved up 60 cents because we've lowered our cost basis 60 cents. Now, of course, there's going to be some variance. If the stock goes down a lot, whatever. But we've still lowered that cost basis, and we're creating movement in the market. If the market is not moving, we're making our own movement, right? Because we are moving our break-even price. We're moving our cost basis. And so that is the significant, ultra important concept. We're making money without having to, as Janae says, we're not putting any more money into our account. We're making some good money. Exactly. And in a sideways market, and again, this is kind of the frustrating thing about Forex trading, right? Is that when things go sideways, there's literally nothing you can do. There's nothing you can do. You just have to sit and wait it out. And I've done that for many, many years. I've had lots of times where I just sit and wait because there's just nothing you can do. We have a couple of Forex trades in the group right now that are just been kind of bouncing around this whole entire time. Now, if those were stock trades, we would have been able to lower that, improve that cost basis, and we'd be in some pretty great shape, right? So we're going to be able to continue to do that on our stock positions. Now, there's going to be some stocks where we say, there's just nothing I can do this week, right? There's nothing I can do, as Eris was saying, and sometimes we might see the implied volatility might be terrible and option premiums might be terrible. Fine. There'll be times that we have to just sit it out and not improve our cost basis too much that week. But there's always something we can do. There will rarely be a time that we just have to sit it out, but there's always things we can do. Of course, right? If something is moving a little bit, we can buy calls. We can always do something to improve that position. And the thing is, whenever we're talking money, right? It's always exciting to say, I made $10,000 on this stock, on this trade, and that's it. I made 10 grand, I made 20 grand, I made 50 grand, whatever. Whenever we're talking money, the smallest things make the biggest difference, right? Is anybody here in debt? You don't have to tell me, but if anybody here is in debt, chances are, unless you had some catastrophic hospital situation and you got hit up with $1 million in hospital bills that your insurance company wouldn't cover, or you don't have insurance or whatever. If you're in debt, chances are it took you a long time to get in debt, right? Maybe it was some bad spending over the last 5 years and credit cards started filling up and other things started happening, right? It takes a lot of time to get there and it takes a lot of time to get out, right? Small little payments and so on start to clear up that debt and all of a sudden you're out of it. But we always want to just focus on seeing the big things. I want to see big wins and I want to see big progress and I want to see big, right? And that's where everybody gets caught up. That's why trading agrees with me, because I'm just a snail. I just want to kind of crawl along and just make some progress every single day. But the progress is not nothing, right? The progress is very significant over a fair amount of time. So when we're talking about lowering this cost basis week after week after week, if you're picking up $2 or $3 or $4 a month, potentially, of lowering that cost basis, that makes a huge difference over a several month period, right? Especially if we're in kind of these buy and hold kind of situations where we're saying, I want to, CLF, we want to hold on to CLF for 20 or 30 more dollars of profit, right? We want to get this CLF up in the, 30, 40, $50 range before we sell it. But what if by the time CLF is up at $70, our cost basis is at $5? Right? Now we have $60 in profit, right? Or $65 in profit per 100 shares you own. And that, or per share, but $6,500 per 100 shares you own. I mean, that becomes a significant gain on a single stock. And it just comes from picking up a couple of cents every week. Makes a huge difference. So when we're looking at some of these stocks that have kind of just been tired and sideways and consolidated, that's when we just sell the heck out of these options and just keep lowering that price. It's so important that we understand this concept, and it is the only thing I wanted to talk about today. Slow markets, slow stocks, sell options, lower that cost basis, and in less than a year, you can own every single stock you have for free. You could have 5,000 shares of stock that cost you absolutely nothing, right? Absolutely nothing. And that is maybe one of the most important concepts in option trading that exists. I have I think one of the things that got me thinking about this was I have multiple trading accounts and I have to for various ventures that I'm in and so on. And in one of my trading accounts that's not with Tastyworks, and I love Tastyworks so much, they're my favorite. One of my trading accounts not with Tastyworks, option approval was being so slow coming through, so slow, and it took like 3 weeks. And I bought some stock, and typical stock. They wanted some CLF. I bought some Alcoa, some of these basics, and I bought some stock. I had to sit in this stock for like 3 weeks, and I thought, this is terrible. What a waste of time, right? I'm sitting here and there's nothing I can do. I can't sell an option. I can't lower my break even on this stock that I own for 3 weeks. Buy and hold is the absolute worst strategy on the planet, if not accompanied with options. It's terrible, right? It's terrible. And you can make a lot of money on buy and hold, but you can make 5 or 10 times the amount of money with buy and hold along with selling options weekly with that. So that's a concept I want everybody to get so comfortable with. I literally have nothing else to talk about today because I want everybody to ruminate on this. I want everybody to kind of think about this concept and say, okay, I own stock. It cost me money, and I can own this stock for lesser and lesser and lesser prices until literally the stock is free. I mean, I just cannot think of another thing out there besides a sweet Ponzi scheme run by Bernie Madoff where you can, get magical results like that. There's just nothing else out there. There's just nothing else. So it's so important. We need to sit on this for a second. Let me answer some questions here real quick. Errors, understand the covered calls are not resulting in less margin. However, the put results in buying power reduction. Yes, it's a good point, Eris. So covered calls actually free up a little bit of margin. Naked puts tie up margin. So a short strangle does cost you some money. Credit spreads are very cheap, right? Credit spread will cost you, it ties up about $50 per contract that you trade in a credit spread. So it's pretty cheap. So credit spreads and covered calls are very cheap. Selling puts, definitely more expensive. And on some stocks, it's really expensive, right? Some stocks that don't have much margin or any margin at all, selling puts can be really expensive. But for most stocks, it's not too terribly expensive. I mean, if I look over here at CLF, if I want to sell a short strangle, or just if I just want to sell a put on CLF, I want to sell a $16 put and pick up 20 cents over the next 8 days. That's going to cost me $230. Not terrible, right? If I want to do, a credit spread, that's going to be a little cheaper, right? $66. So it's not terrible. It's not horribly expensive, but it is certainly more expensive to sell a put than to sell a call if you own the stock. So it's a good point. As far as better returns with margin tied to brokerage. Yep. So selling puts and selling calls are good. I like selling short strangles whenever possible. Now, a differentiating factor here, if you can sell a short strangle and get the same credit as selling a put, selling a credit spread might be a better option. Sometimes we can get like twice as much selling a short strangle as we can selling a credit spread, right? And so then we want to try to go with that short strangle. We want to try to get the most money possible. And so we just want to, part of the determining factor of which strategy we're going to use is which one pays more for that specific stock that we're looking at. How much money do we have available in our account? And do we want to potentially own more stock or no? Because if we're selling a put or a short strangle, we kind of have to plan on owning more stock, or else we could end up taking a big loss trying to close a put if the stock, makes a big spike down, right? So we kind of really want to be able to own that extra stock. So yeah, it's a good point. It's a good question, Eris. Thanks for bringing that up. Make consistent income. Yes. Hey, Peggy, nice to see you. It would be great to understand the strategy involved in knowing which option you decide to use. Janae, hopefully I kind of answered that question. Did that make sense? So I would say the factors for me of which strategy I want to use, just to kind of run over this real quick. I use the factor of which is paying more. So that's thing number one to think about. Number two, am I willing to own more stock? That helps us decide. If we're absolutely not willing to own more stock, it's always going to be a covered call, right? And then we're going to use obviously the available there we go. Available, help me folks, I'm spelling everything wrong here. Available, funds margin in the account, right? So these are kind of the three things that I look at. Now, when we think about, some of these stocks seem to be very, very steady and very stable, right? CLF, it's pretty easy for me to determine to sell a short strangle on CLF because I look at CLF and I go, okay, I can still make pretty good money doing a week-long strangle on CLF with like a 19 and a 16, a 19 call and a 16 put. If CLF goes below 16, yeehaw, I want to own just gobs of it. If it goes above 19, it's struggling in those upper areas. So if it's starting to make its way up there, I can just close my short call. And, I might have to take a small loss in there. I might be able to get out of break even. I might be able to get out with a small profit. But those are the things that we want to kind of consider, right? Do we have, and I would say that, probably item number 4 is clear levels to trade around, right? So do we, CLF real clear, right? I know that it's struggled up at 20 and it seems to be holding pretty well in kind of the mid-teens. We've had little short quick dips down there, but it seems to be holding pretty well. And so I can look at that and say, okay, I've got some pretty good clear levels to work with. And so, I can do that. Same thing with X and some of these other ones, right? I can find some pretty good levels. I can say, okay, if X goes below $20, that's great. I'll own X below $20 any day of the week. And X has really struggled up in, kind of the $25 range. Yeah, it spiked up to $27.50, but that was very short-lived. So I can look at this and I can say, okay, 20 and 25, great area, right? Super, super good area. So, so those would just kind of be a couple of factors that I would take into account when doing all of this. Okay, Hugo, can you do a quick overview of Tastyworks when a chance? I was planning to get the platform, better understand your strategies. Hugo, I've got some videos that go over the platform. So yeah, I'll send you some of those videos, platform tutorial videos. So yeah, I would definitely get set up with Tastyworks. I've got 4 or 5 videos I'll shoot over to you that just go through the platform itself. Super easy to use, wonderful platform. Dom, if trading in an IRA account, will you be limited to cash covered puts, no margin loan? So yes, if you're in an IRA, you're going to have some limitations in that, you can only sell call options if you own the stock, and you've got to have enough money to own the puts as well. So yes, it gets quite expensive to do some of that stuff in a no margin IRA account. I know some have IRA accounts. And so, in that case, then, selling call options will be your, probably your best bet. Call options and credit spreads will probably be your best bet there. So good. How are we doing? Do we have any questions? Do we have any comments? AAL's on your, yes. Yep. American Airlines is a good one. Now, one thing I want to talk about and look at here, guys, is I've had this question several times, and I just want to take the opportunity to clarify this. It's come many times in the chat, in private messages, and so on. People say, why don't we sell call options on stock after it's taken a dip? And I just want to take 1 or 2 minutes to talk about this. I've talked with some of you guys individually about it, but I just want to make sure we're clear on this. If I own CLF at $15 and this stock runs down to $16, and I sell a covered call on this dip, usually after a dip, there's a rally. And I'm selling lower strikes, I'm getting lower premiums, and I'm potentially stifling my trade that could make a run. So remember, sell calls on highs, sell puts or short strangles or whatever on dips, right? Because whenever there's a dip, especially when we're trading these bullish stocks, when there's a dip, there's a rally. When there's a dip, there's a rally. If we're selling calls on the dips, that's kind of like, hey, my IRA account, my investment account, my 401k is down. I retire in 20 years. I'm just going to close everything. You know, you got to wait out the dip. It's terrible to sell call options on a dip because we have to sell lower strike prices. We get less premium. And if there's a rally, we risk getting the stock called away. So on dips, sell credit spreads, sell puts, sell a short strangle because we're going to put that call option way up there because we can afford to put it up there because we're getting credit from the short put, but do not sell call options on dips. Just don't do it. We want to sell calls after rallies and we want to sell puts and credit spreads and short strangles on dips. Okay, Lenny, would you ever use this strategy without owning the underlying stock? Pretty much no. I mean, credit spreads, yes. Short strangles, I'd say pretty much never. And certainly not selling. I certainly wouldn't sell a short call option with no stock attached to it. So yeah, these are pretty much only things I'll do if I own the stock. Good question. Good question, Janae. I'm amazed when I see how much I actually own because of margin purchase. Yep, my margin's good. Super important. Okay, how do we feel about that? Is that making sense to everybody? Is that all good? You guys good with that? We'll keep the webinar a little short today. I want to answer any questions that are burning related to all this stuff. But this is how we own stock for free, guys. This is how we can literally rewind time and buy the most awesome, fantastic, excellent stocks that we should have bought 7 years ago at whatever price. You can't do it with Bitcoin. You can't do it with currencies. You can only do it with stocks by selling options. And it's so important. So important. What would you do with APA also strangle? Yeah, stock for free. We love it. Eras, APA, also a strangle. I don't have a strangle on APA. You could do a strangle on this. I think I have a credit spread on APA. But, you know, depending on where you own it, I forget where I own APA, but, you know, we just want to make sure that the numbers are good. Now, I'm usually going shorter term, right? I want to be shorter term. APA seems to be struggling a lot around 19, you know, ish. Doesn't seem to be wanting to go too much beyond that. So for a week, if I do a 19 and a 16.50, I can pick up 35 cents. That's significant, right? If I say, okay, APA is not going below 17, I can pick up 40 cents. Maybe I want to go back down a little bit there, 30 cents. I mean, there's, you know, pretty good numbers there by kind of staying in that range. APA has, you know, I think APA has struggled, and that's what we have to look at as well, right? This one's kind of struggling to get, you know, if APA goes above 18.50, fine. You know, I'm okay with that. I can move my short put down here a little bit, pick up 39 cents. I think it's going to take APA a little while to get above 18.50, 19 bucks. And I don't think we're going to see it get too much below the kind of the mid-teens here. So that's kind of the area I would look for. 16 and 18.50, pick up 40 cents, 39, 40 cents for being in that for a week. And that's a significant amount in that cost basis lowering. You know, when we're thinking about, hey, I can own this stock at 0 in 35 weeks or whatever. Sounds like a lot, but 35 weeks will come and go. And if you have a bunch of stock that cost you nothing, I mean, that's amazing, right? That's how many people got, you know, gifted stocks by their grandparents that they were able to buy at this crazy low price. Well, we could do that. If you guys just wanted to buy a bunch of stock and hold on to it and reduce your cost basis constantly, you could literally just own everything for free. I mean, that's not any kind of over exaggeration. That's how we could do it. Dom, a naked strangle will likely tie up a lot of buying power. Yeah. So let's see. What's a stock that we don't own that's fairly cheap? Oh, let's see, GE. This one's a pretty cheap one. If we were to do, you know, kind of our typical, here's GE trading at 13 and change. Let's say we sell at 14.50 and buy at 12.50 on GE. We pick up 27 cents. You know, it ties up 238 bucks. Not too bad. Not too bad. That's true, Janae. This is like having our own Fed, right? Our own Federal Reserve. We just get free money out of this whole thing. So it's just such an important concept that I want to make sure everyone's understanding. Guys, just a quick little announcement. I typed this into the chat. I want to make sure everyone's aware of this. Invite your friends. We have Tom from Tastyworks /Tastytrade. He's going to be doing a webinar with us next month in just a couple of weeks, talking about some of his favorite trading strategies. It's going to be me and Tom and all the rest of you guys. I'm obviously going to invite, you know, a few more people, but I hope you guys are going to be there. Tom from Tastytrade is going to be doing a webinar with me, so that should be exciting. Looking forward to that. So make sure to mark that in your calendars. It's going to be huge. He's going to be in my webinar, so he'll be joining my webinar. That'll be May 19th. I'll send out emails and lots of alerts and so on, but May 19th. So in just a little less than a month, we'll be doing a live session, me and Tom. So he'll be jumping in the webinar. So should be good. Okay, guys, that is that's all I have to say. Yeah, it's going to be awesome. It's going to be really good. That's all I got to say about that, everyone. Lovely to be with you all today. Does anybody have any questions related to what we have talked about that have gone unanswered? Every time I try to make a webinar like 30 minutes, I just can't seem to do it. You guys feeling okay? Everyone crystal clear on everything? Okie dokie. Lovely to be with you guys. We'll see everybody tomorrow morning in the live webinar for you lovely members. Great to be with you guys. Have a wonderful rest of your Thursday, and we'll see you guys tomorrow morning, bright and early. Thanks, everyone. Take care, guys. See y'all.